Welcome. I'm Nathaniel Evans. On behalf of Utah Valley University's Plan Giving Department, we're thrilled to host this online workshop focused on ideas for investing for your future. As Utah's largest public university, Utah Valley University is committed to serving the community through accessible education and student success. We appreciate the community members and alumni who serve our students. We hope this workshop will inform and inspire you as you plan for your future. This seminar is part of a series focused on important financial topics presented by seasoned professionals in exit planning, estate planning, taxation, finance, and investment management. Many of our presenters serve on Utah Valley University's Gift Planning Advancement Board that encourages and enhances engagement and philanthropy at our university. Before we get started, I would like everyone to know that the Q&A feature is enabled. Please feel free to submit your questions at any time during the webinar using the Q&A panel. We will be monitoring your questions throughout the session and will address them during the Q&A portion at the end. During this webinar, your video and audio features are disabled to create a focused learning environment. We appreciate your participation and look forward to your questions. We hope that participating in these seminars will equip you with the knowledge and practical strategies to prepare for a confident and peaceful future with your chosen financial professional. Thank you for joining us today, and we hope you find value in the information presented. At this time, I am honored to introduce our esteemed presenter, Carrie Wasden, a seasoned investor who will provide you with valuable insights.
Good afternoon, everyone. I am Carrie Wasden. I am a professional in residence at Utah Valley University and a senior partner at Keeler Thomas. Today, I'm excited to talk to you about investing. It's perhaps one of my favorite things. I started investing when my father gave me a subscription to the Wall Street Journal when I was 16. I bought a few stocks. They supported me on a mission for the Church of Jesus Christ of Latter-day Saints. And I came home and gave it all up, decided to go into medicine. Over the course of my training, I found my way back to investing, went to New York City and worked for JP Morgan, was a investment analyst for almost 25 years. And now I'm teaching at Utah Valley University and trying to share the information that I've learned over the years. I'm going to go ahead and turn off my camera for just a moment, and I'm going to get our presentation back up and running, and I'll be back to you in just a second. Okay, we should be together. Let me tell you our plan today. Our plan is to start by talking about storytelling. And the main reason is that's all investing is. Investing is creating a narrative, creating a story. Hopefully it's a true story because it has to be a story about the future because markets don't really trade on the past. Markets trade on how things are going to unfold. So we'll talk about narratives, how to create a narrative. We'll stand on the heads of giants. 5 investors who have really defined investing in modern times. And if I do my job right, I'll be able to explain them, be able to talk to you about the principles that they have created. We'll summarize those principles into some principles that we can use. And then towards the end, we will have created a narrative for ourselves based upon the current market environments and current economic environments. I'll lead the way in that, but I'm hoping that your questions and responses will help us create a narrative for you as well, one that you can use. We'll end the presentation by talking about an investment strategy that will work for the months and years ahead. Let me start out by mentioning stories and how they work. Markets are not just numbers. They're narratives. They have characters, which we are using as companies. They have plot twists, and those could be earnings, crises, innovations. There's rising action, and there's resolutions. Those are returns and losses. A successful investor is able to understand the underlying narratives of a story through the assessment of data, trends, and a bit of prognostication, a bit of looking into the future and finding things that aren't particularly obvious. Remember, markets are interested in the future more than the past. We need to have good stories that are going to be accurate stories. So we can't just create a story and hope that the market finds us and follows us. We need to create the story that the market is going to find and then invest accordingly and take advantage of that. Just as a basic principle, first principle for the day, in the short run, markets are voting mechanisms. In the long run, they're weighing mechanisms. What that means is there's a lot of data, a lot of stories, a lot of opinions flowing into the market, and the market is constantly going up and down, trying to find reasons to take that information seriously. That's why we have volatility. That's a short term. But in the long run, markets are weighing mechanisms, which mean they look at fundamental information that has a high probability of occurring and they discount that into prices. Short run, it's a voting mechanism. Long run, it's a weighing mechanism. And that's how things are discounted. So here we're going to look at narratives or stories as they've unfolded over a period of time. If you look back just a little bit before the pandemic, and if you're old enough to remember this period, we were in what was called a Goldilocks period. All that means is everything was just right. We had low inflation, we had strong, moderate growth in profits, economics. We had interest rates that were largely accommodative, really coming out of the credit crisis era. Interest rates, for the most part, remained very low and accommodative. Everything was just right. And then in January 2020, the pandemic flew in upon us, and our response was quick and forceful. We put almost $20 trillion into the US economy. But in that first quarter, it was uncertain. We didn't know what was going to happen. What was interesting is during the credit crisis, it took the government 18 months to come up with a solution and a response. During the pandemic, it took 18 days. So the response was quick and forceful, $20 trillion into the economy, and that infusion of capital caused the economy and the market to take off. That narrative or story continued through 2021. Now, the problem is we had so much money and chasing so few goods and services. A lot of us still couldn't travel, couldn't leave our homes. We had all this money to buy goods and services that were largely unavailable to us. That created inflation. The response was higher interest rates, and higher interest rates caused 2022's decline in the markets. But then in 2023, really at the beginning of 2023, artificial intelligence, which has been talked about since World War II, really started to be real. Mainly at a bit of a trinkety stage, acknowledged, but it was real. It was something we could look at and see and watch. At the same time, inflation seemed to be trending lower, not as low as we wanted it to be, but it was trending lower. And this combination really lit the markets on fire. And that led us into 2024, where AI was just going to be the coolest thing around, and it was going to provide us with endless money and never having to work. And then we hit 2025. And we started out with President Trump's administration deciding they were going to tax or put tariffs on goods coming into the United States. That uncertainty caused the markets to respond negatively in the first quarter, but largely yielded to the gains expected from artificial intelligence running through the rest of the year. And now we're in the first quarter of 2026. And now we're in a situation where everything is different. Certainly, artificial intelligence has not stopped. The promises of artificial intelligence continue to weigh on everybody's mind, but markets are less likely to give them credit without a little bit of results. The voting that occurred in 23, 24, and 25 is now yielding to weighing. And we're starting to weigh and say, all right, we've already paid for this. We've paid for the future, for the hype, for the hope. Where's the results? a very typical response moving from voting to weighing, and that has caused markets to be a little bit concerned. Now, putting on top of that, we have an overlay of geopolitical concerns that are clearly weighing on things. Inflation seems to be a little bit higher than expected and has stopped going down. All of those things are combining. A narrative is never having to do with one single element, but all of those things are weighing on the markets now, and they're looking at it going, I'm not sure where this narrative is going to really end up. That is really common when you have a change in narrative. See, our narrative was really from 22, 23, 24, and 25, mostly about artificial intelligence. And now we're changing the narrative and we're trying to find out which pieces are going to last and create a narrative that can feed us and feed investors and guide investors for the next few years. That's normal. Let's rely upon some of the best investors of our time. We have Benjamin Graham. We have Warren Buffett, who is actually a student of and mentored by Benjamin Graham. We have Peter Lynch. We have Sir John Templeton and Ray Dalio. I'm going to walk through some of those basic principles that they've spoken about. I'm going to do it quickly. There are literally books on each one of these investors and what they do and what they did to really be successful at investing. So I'm just going to focus on 3 principles from each one of them, and I'll try and talk about those principles in a little bit. And then at the end of this section, I'm going to give you 5 principles that we can take to the bank and learn to use as we invest. So the first one, Benjamin Graham. He's really the father of value investing. His first principle says, hey, look, you need to find a margin of safety. And all that says is there's an intrinsic value that we can calculate for what a company is worth, and we need to buy it less than that. Otherwise, there's nothing for us to have. He also proposed this idea of Mr. Markets, that markets were voting machines in the short run and weighing machines in the long run, which we've already spoken about. That was his idea. He also put forward an idea that intrinsic value was something that we could find out. And that when we buy stock, we're not buying a piece of paper, we're buying a company. And when we buy a company, we need to treat our investments as if we are buying the whole company, even though we're only buying a piece of it. That created a whole business around a fundamental analysis, the analysis of characteristics of a business to see whether they're positive or negative, and then valuing them and seeing if there's a margin of safety for us that allow us to invest in it and make money at it. Next is his protege, Warren Buffett. Now, most of you know who Warren Buffett is. I've had the honor and the opportunity to work with Warren Buffett for many years. He had a number of key principles, and they sound and feel a little bit like Graham's, but they're different. Notice we're not talking as much about margin of safety. We're looking at fair prices. And he's saying buy wonderful businesses that have moats. All a moat is it keeps the competitors away. They've got to have some sort of competitive advantage that says it's not easy to do what we're doing, so we need to have a moat. And we're going to be able to buy them at fair prices. Margin of safety, not nearly as important, still there, but we're looking for fair prices. His position is, I would like to own these stocks forever. The reason why is this idea of compounding. This idea is that if I own this business and they're good enough to grow every year and to pay me for being an investor in them, I can just sit back and let that compounding work for me, because every year my stock is going to be worth more and more as long as they continue to grow and grow. He also stressed the idea of don't invest in things you don't understand. I had a series of opportunities to work with him where he would say, don't make a decision unless you've done 80% of the analysis. Now, nobody knows what 80% of the analysis is, but you can feel it. When you've looked at something over and over again to where you feel like there's nothing really left for me to know. Okay, so do that much work before you decide to make a decision. But when you've done it, make the decision. The idea of competence in doing things and investing in things that you know is really, really helpful. If you are an avid Costco uh, customer, you go there every time, you know their system, you know how they work, that would be a really good company for you to look at and see if it's worthy of your investment because you know them. Warren Buffett, for many, many, many years, didn't invest in technology because he didn't feel like he understood it. Now, you may know that he's recently been a very large investor in Apple, has reduced his position meaningfully. But that's a pretty big departure for him. But he got to the point where he felt like he understood it. And so he invested in it. Let's take a few steps into Warren Buffett's theories and ideas and see how it works. If you had invested in Berkshire Hathaway and invested with Warren Buffett, and you say, you know what, I'm going to invest $100 back in 1965, and you just held on to it, just let it ride. Today, that would be worth $6 million, as opposed to the S&P 500. If you just bought the index, you'd be worth 38,566. Now, the S&P gave you a great return, but nothing as good as Warren Buffett's Berkshire Hathaway. So his record and his reputation has been stellar. In the same point, he mentions the idea of compounding and not to lose sight of what compounding can do for you. This top line is compounding at 10%, and the bottom line is compounding at 7%. That marginal increase in 3%, which you can attain as a very modest investor, is doable. And it's doable by just spending time watching, monitoring, and taking care of your portfolio. The last one for Warren Buffett is this really interesting idea of staying in the market. The red line is your return from 2006 if you had been out of the market for the 10 best returning days, 10 best single days that had a return. That's your return. The blue line is if you just stayed in the market and let it do its job. Now, what's interesting, especially given our current environment, is that 8 of those 10 best days occurred during the credit crisis and the pandemic. So times when people were nervous, times when people were saying, I think I'm going to get out. I'm worried. I want to get out of the markets. If you had gotten out and missed those 10 best days, your return would have been the red line. If you had stayed in, your return would have been the blue line. This yields a couple of really interesting principles. Number one, it is really hard, and I would say impossible, but it's really hard to time the market. People who have timed the market professionally over time consistently, they don't exist. There are none. People who have timed it a couple of times and have created newsletters out of that, those people are around. But they don't typically do it more than once, and at the outside, maybe twice. So staying in the market has real data to support it. It's not just a talking point. Looking at Peter Lynch had a very interesting view. He thought, look, normal people who don't do this for a living, they can beat the market by basically paying attention to it and being aware of what is happening. He had similar principles, though. What you know, invest in what you know. He also said, do your homework, pay attention to company fundamentals. What is driving the business? What is driving the earnings and profitability of these firms? Know what it is. And keep track of what you own and why you own it. Keep your eyes on your basket and don't let anybody touch it. Now, this is an interesting picture. He looks a bit like a zombie. Sir John Templeton was a wonderful, wonderful human being. This picture doesn't portray him that way, and this picture is an attestation to artificial intelligence. All of these pictures were created using AI, and this is one of the problems with AI is it doesn't always yield exactly what you asked it to. Given my time constraints, I started working on this presentation last night, and this is as good as I could get, and I kept asking it over and over again to change things, and it just couldn't figure it out. Now, the reality is that will change significantly over time. But right now, we're still dealing with a few quirks. Templeton's principles, he is the man who who really discovered and named emerging markets. He said, look, we should look outside the United States. We should try and find opportunities in places where few people go. And he said, and we should invest when people are really negative. Again, interesting principle. Warren Buffett confirmed this. He said, be greedy when other people are fearful, and be fearful when other people are greedy. So find periods of maximum pessimism and find areas you want to be in. Have a global view. Don't be so particularly fixated on the United States of America. That doesn't work for everybody. Sometimes you say, I'm a US citizen. I need to be invested in dollars. I'm only comfortable with that. That's okay. But realize that 40% of the earnings of the S&P 500 come from outside the United States. So even if you choose to not invest outside directly, you need to understand that the companies you're investing in the United States have a significant exposure to places outside. This is also a trend that keeps coming up over and over again. Be able to separate signal from noise. There's a lot of noise. And with social media and our evolution of media content that we have now, there is infinitely more noise than there ever was when Sir John was around. But you need to be able to separate it. Have an open mind. Go everywhere. Geographically, culturally, and intellectually. I once had a conversation where Sir John and I told him what I thought was worthwhile in Argentina. And he said, when's the last time you were there? I said, 5 years ago. He says, you don't know Argentina. You need to go again. And his point was really interesting. We tend to see these countries as the same way they were when we saw them last. And so we need to constantly have an open mind, constantly be aware. This idea of signal and noise is so critical. He left New York City and built a home on the top of a hill in Nassau, Bahamas, because he wanted to be away from the noise of Wall Street so he could make his decisions right and not be influenced by the noise. Last person on our list is a gentleman named Ray Dalio. He's the founder and ran for many, many years Bridgewater Associates. It was the largest hedge fund in the world. His views are very well educated. If you read any of his books, watch any of his YouTube videos, stunningly brilliant man. His point is radical diversification. You need to have 15 to 20 uncorrelated return streams. That just means if one goes up, one's likely to go down or not move at all. They're not all tied to the same factors driving their performance. That's diversification. He also believes you really need to understand macro. If any of you have been to college and you took your macroeconomics course, that's probably the first class you brain dumped as soon as you walked out of it thinking, I will never have to know anything about this. That's probably the only class you still need to know about. So paying attention to macro events, watching YouTube's, watching these types of individuals who do a lot more research than we will ever do and see what their views are. But remember, markets are made by people who disagree with one another. Even among the brightest people, there's still avid disagreements, and you need to take that into account. The last one here is have an open mind. What you will find over and over and over again is how relentless this principle is. Radical open-mindedness and battle-tested ideas. If you feel you're right, you should surround yourself by people who disagree with you. That's the only way you can battle test your ideas. Frankly, that works in every part of your life. So be intellectually honest, fight against biases, remove emotion completely from the system, and be endlessly curious. Basic principles that Dalio has been espousing for many years. So what principles can we take home? We can determine the difference between price and value. They're not always the same. In fact, they're rarely the same. Value can be known. If we can know what the value of something is, we can make investment decisions that are very likely to be accurate, certainly over the medium to the long term. Be patient and long-term thinkers. Think about risk before you think about returns. Risk is protecting the returns you've already gotten. You don't want to put those at risk. And then returns are looking into the future and finding how can I get some more? How can I maximize my opportunities in a future that is unknown? Emotion as enemy. And it's as an enemy to us, but everyone else's emotions create opportunity for us. Market irrationality is our advantage. Be greedy when others are fearful, and fearful when others are greedy. Again, that's a Warren Buffett quote. But use the emotions of the market to your advantage. Don't be afraid of them. Last one, which works for everybody, never stop learning. Consistent and persistent curiosity is the investing superpower. So let's take these 5 principles, and I think we're in really good company of saying these are the ones we should endorse. These are the ones we should own. And let's take them and apply them. Remember, markets are not just numbers. They're narratives with characters. Those are the companies, plot twists, arising action, conflicts, and resolutions. Let's talk about the one we have now. Year-to-date return. We had mentioned at the front of the presentation that we are currently involved in a great rotation. These are the year-to-date, which means January 1st to last night, the year-to-date returns by sector. Energy is the best one. Well, that makes sense. We bombed one of the largest producers of oil, and so oil prices have spiked close to $100 a barrel. And so that makes energy a notable winner. But look at the other ones. Materials, staples, utilities, industrials. Now, these aren't necessarily knockdown returns, but they're meaningful for the first quarter of a year. But look at the ones that aren't. By the way, healthcare is not there, but it's a good return as well. But look at the ones that are doing poorly. Communications, discretionary, technology, and financials. Communications, discretionary, and technology, they did really well last year. In fact, they led the market, and they're not doing the same. So we're seeing a rotation out of what led the markets for the previous 3 years. And we're seeing something different. We're seeing a move in the markets more towards protection. So we need to get to the point of answering, well, protection from what? Now here's year-to-date returns again, but this is by investment instrument. And you can directly invest in crude. So crude is the best returning. Gold's still doing well. Commodities also doing well. Commodities are heavily influenced by crude and gold. So there's a little bit of cross-counting there. The bonds have been protective. They've been paying you a yield, but in terms of price response, they haven't been going up. They've been going down slightly because interest rates have not been going down. So that's been penalizing them. But the S&P, NASDAQ, the Magnificent Seven, those 7 stocks that accounted for almost 45% of the market value of the S&P 500, they're taking it on the chin. And Bitcoin, which is the ultimate indicator of risk-taking behavior in the marketplace, also not doing well. Again, keep in your mind the theme that we're seeing this great rotation away from the things that worked for us for 3 years that aren't anymore. Part of that rotation, however, is an anomaly. Money losers amongst this group of equity instruments is the best performer. AI is still doing well, but it's not the same AI players that were. Mid caps, which is middle-sized companies, and small caps are doing well. But again, the players that brought us to the ball the last 3 years are not performing. This rotation continues. Most of the reason for the money losers performing so well is that a lot of them are related to structural shifts taking place in artificial intelligence, and so they continue to perform. Now, let's talk about this behavior of becoming less risky. This is money market account balances, which is a good way to measure risk-taking behavior. And what it's showing is people, investors, companies are parking an increasingly larger and larger amount of their money in instruments that yield a little but don't suffer price depreciation. And we have almost 8 trillion US dollars in money market account balances. Notice how different that was from where we were in the internet era to now. We're 4 times where we were before. All right, let's talk about valuations to see what's happening to valuations. We have a number of ways to look at this. I'm going to give you a quick intro to valuation, which is way insufficient, but will get us through this presentation. When you buy a house, you look at your home and you say, here's what the price is. If my home is 4,000 square feet and the price is $400,000, which is a pipe dream in these days, but say it was, my valuation metric is price per square foot. I'm paying $100 a square foot. Okay. The same thing works with stocks, except we don't have square feet. We have earnings, we have sales, we have book value. So we take the price to sales, price to earnings, and price to book value as different valuation metrics. And we look at what we see in general, price to sales, a long-term trend of rising higher and higher and higher. But if you look at where we are versus where we were before the credit crisis, we're extremely expensive. Down here, price to earnings ratio, it's come down a bit, but what you do see is you have a significant structural change in the PE ratios have been rising. And why has it come down a little bit? Because the companies that have been driving earnings and driving prices, which are the Mag 7 names, have really been taking it on the chin. So that's taking that valuation metric down. Price to book value is just the equity value of a firm on their balance sheet. And you can see from the credit crisis as well, that's been flying. We're way higher than we ever were. Part of the justification for this, you can look at it and say, yeah, but, now here's the yeah, but, profit margins. Look at profit margins in the era just after the internet bubble burst, down to 2%, and we're almost at 12%. So your profit margins are 6 times what they were before. That's a reasonable justification as long as it continues. But it still doesn't get you to being as overvalued as we are. Now, if you wanted to look at the United States versus other countries, last year, other countries blew away the United States in terms of returns. And so you look at that and say, well, yeah, they're probably expensive now. Well, they're not really. The United States, the NASDAQ is our technology index. The NASDAQ 100 is the largest technology index. The Dow is an industrial average. The S&P 500 is the broadest useful average that we have. Those are all shaded there. The US is still really expensive compared to the rest of the world. So look at that and think, have we gotten to a point where we feel like there's value in the United States? Well, not in the broad indexes. Certainly there's some companies that you would look at and say, I think there's value here. I need to do some bottom fishing or be greedy when other people are fearful. So that opportunity we'll talk about in a sec. So let's talk about another part of our narrative. 70% of GDP growth is consumption. Consumption is completely dependent upon the labor market. So let's see how people look at the labor market, how companies look at the labor market. The first one on the top left is it hard to hire people? And the index there is going way down. So we're well below where we were before the pandemic. It's just not hard to hire people. People are out there. I can hire them if I want them. Just below that, openings per unemployed person. During the pandemic, we were just struggling to find enough people to work. And now we have fewer openings per unemployed person than we had before the pandemic. To the bottom right, this is a really important graph. This is the number of jobs that have been created in the United States. And you can see that just after the pandemic, there were a lot of jobs. Now you get down to where we are today. Some months we have a job creation, some months we have a drop. Now what you see is we actually lost almost 100,000 jobs in the last month. But what's inside those numbers, which is slightly terrifying, is that if it wasn't for healthcare, which grew by 500,000 jobs, we would be meaningfully lower. The point, the labor market is softening and softening radically. When you think about how you create a narrative about this, it's reasonable to say that if we don't have a broken labor market, we won't get a recession. if we do have a broken labor market, we are very likely to get a recession. Recessions cause significant declines in wealth, which lead to significant declines in investment, which leads to a cascading effect, and markets tend to drop between 20 and 30% during a recession. Now, think in your own head, when I say that, how do you feel about that? If your response is, I got to get out of this market, keep that in your head. We're going to talk about that in a minute. If your response is, I got to prepare for the opportunity ahead, keep that in your head. We're going to talk about that. Now, what makes the labor market different today than it was in the past is this little guy here, business formation. Notice we were pretty flatlined before the pandemic, went down a little bit, people were freaked out, and then it jumped up and it's remained relatively high. These are new businesses being formed. These are people getting a side hustle, doing a second job. So now if we lose our job, it's not totally off the table, but we're not nearly as concerned because I can always do this other thing that I picked up during the pandemic. So the impact of a broken labor market, W-2 employees that we track, may not be as acute as it has been in the past. Think of that as we create our narrative. Now, here's one that should probably terrify you. This is consumer sentiment. Where we are today, over here on the bottom, we're not at the all-time bottom, but we're not far away from it. And we're certainly at levels that we have been in previous recessions, which are these shaded areas. So if you were looking at this, you would say, this presents some cause for concern, only because if you added to that a broken labor market, which we haven't experienced yet, this could be fairly problematic. So what's interesting so far, though, is that consumer sentiment is low and we are still spending, maxing out our debt and our credit. We're spending and sales are going up. So we're spending a lot. We're not feeling good about it, but we're spending a lot. So an interesting phenomenon, you could say, yeah, but people are still spending, and that's totally okay. But think about the other side of that narrative. They are, but what happens if the labor market starts to crack? Then they're already feeling bad. They're already over indebted, and the labor market starts to crack. That's going to create some challenges. Now let's get down to a little bit of our discussion on geopolitics. This is crude oil prices per barrel. You can see that it goes up and down a lot. Now think about our narrative about labor market, about possible recessions. Those kind of things all play into this, but so does crude oil. Crude oil prices being so high in American terms is a tax. We are going to have to spend more of our disposable income on this than we have in the past. And that's going to mean we're going to have less money to spend elsewhere. So crude oil definitely has an impact on us. And the events taking place in Iran, however you may find a way to justify them for getting rid or trying to get rid of an oppressive government that is just murdered and beaten its people for decades, there are prices that will be paid, and you need to be able to put those in your narrative. So let's create a narrative. Let's talk about 6 things that we can put in there. Consumer. Consumer remains strong, stubbornly resilient, but fully employed. They seem to have been able to stomach inflation, largely without skipping a beat. Higher interest rates haven't stopped them from buying things. But there's 2 sides to this coin. Some call it a K-shaped economy. The really wealthy people continue to spend. But those who are making $150,000 and less are not. They're retrenching. They're digging deep. What is so interesting about this is that now if you get a slower stock market or a lower stock market, and your housing prices are no longer going up, you have a declining wealth effect. The wealth effect accounts for 25 to 30% of all consumption. If your house price is going up, Stock market's going up, you feel wealthier. You got more money. Why not go spend a little bit of it, or go spend some money because you've always got this wealth back in your house and in your stock market. If neither of those two things are growing now, that puts a real lid on both the willingness and the ability of a consumer to continue spending. That is my narrative for the consumer. Geopolitical, as sad as it may sound, geopolitical events have very little impact on stock markets unless they impact commodity prices, which they're doing. So the longer crude prices remain elevated, and when I say elevated, it's above $60 a barrel, the more likely that this feeds into the economy and creates economic recessionary possibilities. If you look at other investment banks in the United States, their probability for recession has gone up significantly. That leads us to the economy. The economy is slowed down significantly. We're growing at less than 2% per year. That's not even in line with inflation. So the economy is growing, but slowly, and any meaningful shocks there could be a problem. Inflation is a little bit higher than we want it to be, but it doesn't seem to be out of control. But the Federal Reserve is watching it, unlikely to lower rates significantly in light of the higher inflation. So interest rates are likely to be persistently higher than they were during the previous 15 years. So we're not going to get back to, and we probably will never get back to rates that we were at before unless we have a recession. Valuations. Everything's expensive. What does that mean, and why is that important? Because when things are so expensive, they're sensitive to changes that are not expected. So changes are going to adjust prices really, really quickly and significantly because valuations are so high. How to create an investment strategy on this? Pretty straightforward. Be careful of passive markets. You have grown up in the last 20 years to really embrace passive investing. That's investing in ETFs, broad ETFs and swaths of investing that basically you put your money in there, you park it and just let it go. That's worked great because markets have been on a structural path higher. And the companies that have been driving that have been 7 of these companies that are just becoming enormous, multi-trillion-dollar businesses that are now having difficulty. So that same ship that brought you up, if you're heavily dependent upon passive investing, is going to also bring you lower. So be careful. Focus on structural trends. Artificial intelligence is a structural trend. Sure, we may have a recession, but does that mean artificial intelligence is going to fall apart and not be a trend that is going to be continuing? No, it doesn't. Look at margins. Focus on companies that have strong margins and pricing power, which usually drives their margins. Focus on companies that have unit growth. They're selling more of a thing, not just raising prices. So strong unit growth. Look at strong balance sheets. Companies that have over-indebtedness are going to fare much more poorly when sales and demand are constrained by a possible economic slowdown and or a recession. 6, stay in the game. Don't get out of the game, but think about the principles. Be greedy when other people are fearful. Be fearful when other people are greedy. As fear begins to take more and more of control on the market, take advantage of that. Loosen up on some areas that you've gained significant returns and that seem overvalued. Hold on to your cash and be ready to buy right. The number one criteria for investment success is buying right. The reason why you invest in Berkshire Hathaway at all is because they're disciplined about how and what they buy. So practice the same discipline yourself and be prepared to buy right when the opportunity presents itself. Be careful who you use. We're not making an advertisement here, but interview your investment advisor, your investment company. Spend time. Part of Peter Lynch's principles were surrounded in this really interesting principle, which is if married or significant others would spend 1 hour every Friday or Saturday morning talking about their investments, just being aware and talking about the world events, they could improve their performance by 2% from just doing that thing. So spend time taking care of what you have. Get into your IRA, look at it, look at what you're invested in. Talk about these ideas about what's happening in the world. And that thing alone will make an enormous difference in your performance. Now, my last thing is we go to questions. The question you need to ask yourself is, do you want to milk cows or do you want to buy your milk? Milking cows requires you feed the cow, requires you milk it every morning and night. The milk is infinitely better. The butter, phenomenal. But it takes tending, it takes effort, it takes preparation, it takes forward thought. If you have the inclination to do that, you can significantly improve your returns by being more active. If you would rather buy your milk, if the taste doesn't mean that much to you, you'd rather do other things, then find yourself a good investment company or advisor, but don't just leave it to them. Make sure you stay on top of what they're doing. That process alone gives you 2% additional return. So in any case, be active. But if you're going to milk cows, you got to be a lot more active. If your response to the question was, if I go into recession, I want to be ready to find things to buy, that's a milking cows response. If your response to the question was, I want to get out of here, that's probably a buy your milk response. So try and set yourself up for a strategy that works the best for you.